you all for being here today. All of you are first responders from South College. I'm Jack Cunningham.
Keegan Joplin.
Jake Sherrington.
My name is Will Birch. Chicago Bridge and Iron is a fascinating ENC engineering and construction company. Founded in 1809 through a series of successful acquisitions and steady growth, they've grown to be one of the leaders in ENC. Right now they're in the process of acquiring the Shaw Group, and which will add even more diversity. Right now they offer project services from front-end engineering design all the way to distribution. And for the purpose of this presentation, we'll just be assuming that this will go through. Right now we have a $52 intrinsic value. That's using a PE, EV to EBITDA, and free cash flows to the firm. And then we have a one-year target price of $57. And Zach will get into further detail on that in just a moment. Here's the revenue breakdown for CBI before the acquisition. You can see PEC offers a large amount of the revenues. And then that brings us to steel plate structures, which is a really diverse proportion, lots of different end markets, and they have wider margins, which brings in larger amount of net income. In 2007, they acquired Lummus, which is a really advanced proprietary technology, mostly servicing the petrochemical industry, and this has the widest margins and good growth. Here you can see some of the transaction details, about $3.2 billion transaction, $41 for cash, and then 0.1288 shares of CBI for each Shaw share. We think it's a really good deal both financially and then for the synergies that it's going to offer. We'll get into those in just a moment. And you can see this in our EV to EBITDA multiple decreasing from 12 to 13. And here you can see CBI on the left and Shaw on the right. You can see how heavily oriented Shaw is. These are their segments. They have the power and the plant services, which makes it really unique because they can build these power plants and then service those, keeping the revenue stream going. And then they have environmental infrastructure, which is both public and private, but those are mostly reimbursable contracts, so it gives some margin protection. And then we have fabrication and manufacturing, which offers some real opportunity for CBI because they can use this pipe for their projects that they're currently doing and future projects instead of having to outsource those.
So we are very optimistic for each of CBI's end markets, starting with LNG or liquefied natural gas. With the gas shale boom, the U.S. has increased their natural gas reserves substantially. We see this as an opportunity for those companies that can export LNG and reach those foreign markets. We think CBI will succeed in doing so with their current position in LNG, coupled with Shaw's fabrication capabilities. Gas to liquids, Shell and Sasol both announced future developments in Louisiana where Shaw is headquartered. So we see some opportunities there. Oil and sands. The oil and sands market is currently flourishing within Canadian borders where CBI has been involved. Those awards have been going for $100 million to $1 billion each, and we expect CBI to stay involved with those in the future. As you can see, oil supply has remained stagnant the past couple of years with a slight increase in demand. So we do foresee an increase in oil prices, which could add some value to the oil and sands market. Moving on to petrochemicals. The petrochemicals market is looking good also for CBI with the fact that they can both license and perform these EPC-related projects. Chevron and Dow Chemical also, as you can see from this table, have announced future developments in petrochemicals, and we see that as a precursor for future growth. Power generation. With Shaw being a leader in power, we see it as a huge opportunity for CBI, especially with the growing energy consumption. Especially with the emerging markets like China and India. Environmental, with the Shaw acquisition, we now have the ability to retrofit those facilities that don't meet EPA standards. So there's approximately a $50 billion market there for the next 5 to 10 years. And lastly, infrastructure. The energy infrastructure market is looking up as well with 95 $1 billion projects planned this year and beyond.
CBI has 4 major competitors, Fluor being the strongest of the 4. Its oil and gas segments have shown steady growth in North America and has produced a backlog of approximately $43 billion. Its industrial and infrastructure segment has been one of the primary reasons that its revenue has increased. And along with this, they've recently increased their number of projects by completing several multi-billion dollar petrochemical complexes in the Middle East, China, and Europe. Listed are a few operational risks. Awards that are received by the companies are heavily dependent on the state of the economy. 2009 was a great example of this. With the increased competition in the industry, this puts more pressure on company advisors to bid on certain projects. However, as Will stated, CBI has become more diverse with the acquisition of Shaw, and this will allow them to take on more projects. Contracts are also key in determining the cost of a certain project. Using a lump sum project puts greater risk on the markets. And listed are several possible setbacks or risk to price targets. A couple to take note of is that CBI is currently selling for its 52-week high, and as well, if oil and gas prices were to fall in the coming future, this could either cause for a delayment of projects or the cancellation of projects.
Post-acquisition, CBI's revenue will more than double. We calculated a future revenue growth rate of 10%. This was a compilation of many factors, one of which was the growth of the energy infrastructure, as Keegan mentioned earlier. This opens up many opportunities for CBI to invest. We also looked at the combined backlog, which is roughly $27.5 billion, 9.5 of which is CBI's backlog and 18 of which is Shaw's backlog. We also looked at the cost-saving synergies. First day cost-saving synergies will be roughly $30 to $40 million, as well as the revenue synergies will be $115 million. Also, the acquisition brings additional competitive advantage because CBI will have the largest nuclear engineering amount of nuclear engineers within the company. It'll be the largest that anyone in the industry has. We also considered the possibility of their margins declining. This is due to in the past, Shaw's margins have been a little bit lower than CBI's, therefore we predict that that'll affect their margins in the future. In 2013, the operating cash flow will be overestimated due to the combination of balance sheet items. However, in 2014, we believe it will normalize to roughly $550 million. And we believe it will continue to increase and reach $900 million by 2017. We also believe that CBI will return to their all-equity capital structure. This is what they've done in the past. They've always returned to it, and they always retire their debt relatively quickly. So we believe they'll reach this capital structure by 2017.
Thank you. We use three different models for evaluation: EV EBITDA, PE, and free cash flow. As you can see here, we have the EV EBITDA. We use a multiple of 7. This is in the middle of the 5-year range. For future EBITDA per share, we forecasted to 2017 and discounted back to the present. That gives us a value of $12.27 and the intrinsic value of about 51. Off to the right, you can see our sensitivity analysis. We have a different EBITDA per share and an EV EBITDA multiple. And at the bottom, you can see our model's estimated EBITDA per share growth. PE is very similar, multiple of 14. Once again, for future EPS, we forecasted in 2017 and discounted back. That gives us a future EPS of $6.59, an intrinsic value of about 54. Once again, to the right, you can see our sensitivity analysis, and at the bottom, you can see our model's estimated EPS growth. For our free cash flow, we use the cap to calculate the cost of equity, and that came out to be 11.8%, which when combined with our targeted future capital structure of 100% equity, gives us a WACC of 11.8%. That gives us an intrinsic value of about $52. In conclusion, you can see in the top left that we have a combined intrinsic value estimate of 52.52. And for our target price, we wanted to point out that the E&C industry is highly susceptible to market volatility, and therefore PE by itself would not be the most appropriate valuation method to use. Therefore, we decided to place more weight on EV EBITDA. That gives us a 1-year target price of 57. We would also like to point out that we believe this is a very conservative estimate. We believe that the target price could potentially even be higher. So for right now, our estimate is $57 target price and our hold.
You mentioned that this is a very conservative estimate, and the only factor that I have seen incorporated into your analysis is basically operational risk. did you take into consideration other types of risk? Global, compliance, environmental, reputational, everything?
Yes, absolutely. Biggest concern with the rest of the price target, what will happen in the economy? And that's why we place a lot of emphasis on the sensitivity analysis. What happens if EBITDA per share is less, if EPS is less, stuff like that. Anything else you want to add?
Yeah, I'd say just that on our risk to price target, we've looked at some of the things that we may not hit in our target price. And these things are such as the recession that we had and then the effect in 2009, where the stock price dropped down to $6 a share and how revenue dropped down 21 million.
If you'll go in your slides back to your WACC analysis, your discounted cash flow, can you tell where you got each of these factors, like where you got your data, what you use for your risk-free, your market premium, that kind of stuff? How you got it?
Well, just with our beta, we looked at both the betas for CBI and Shaw and combined the two. I believe it was 1.65, which is higher than most betas. But since the market is so volatile, this is why we use the beta of 1.65.
Where did you get your data? Did you calculate it? You took someone else's?
Yes, we calculated it through using what's it again? We used Value Line and S&P 500 to calculate each section's beta.
And also the risk-free rate, the market rate, we use historical data that estimates that 1.9 and not 6%.
Now, looking at your EBITDA analysis, why did you use 2017 EBITDA as your base?
And why would you do that?
You're using 2017 EBITDA per share?
2017, yeah. The way we did our EPS, the way we do our EPS and EBITDA per share, the calculations, we forecast 5 years into the future, which would be 2017, and this kind of factor effect.
I do methods. So these sort of, what EBITDA multiples do the peer companies trade over the net? Essentially, I mean, EBITDA multiples are generally used here, on the M&A transaction basis for the last 12 months or on a trading multiples basis for the next 12 months. So you generally don't use EBITDA multiples that you realize 5 years from now, because quite frankly, you don't really know whether they're going to be okay with those 5 years from now. So, did you find that in the textbook or it's
that's just the model we use, and once again, we felt very conservative with these estimates, and we analyzed the risk and price target, the operational risk, and I thought that was the best way to go about doing this. But of course, rather not buy something or buy something that I can put them in head. But buy something, you would not want to not buy something and have it go up. We'd rather do that than buy something and have it go down. Therefore, we decided to be conservative.
Now, in terms of geographic coverage, Shaw is very much focused on the United States, right? Geographic base, I think they're like 80% revenue in the US. And obviously, their customers, electric utilities, they're actually in a situation where their demand is forecast to just 1% per year increase year over year by the last 30 years. Demand for electricity will be 1%. That's why a lot of electric utilities are trading below 50% of all time. So, what rationale can it be for CB&I to double their exposure to what is perceived by most economists as a very slow growth U.S. domestic market versus actually increasing their exposure to foreign markets? What's the rationale for that?
Well, I think CBI, the guidance that they gave was not particularly their interest in the U.S. markets that Shaw is in, but using their leverage that they have and their knowledge and expertise to use those in the markets that CBI is already in. They gave us guidance that it would be about 50-50 post-acquisition U.S. to international base. So it'll be completely leveraged between the U.S. and the international and mostly emerging markets, but and lots of those are power and nuclear power internationally.
And that's another great thing about this acquisition is just how much diversity it brings to CBI. Now CBI can do a whole lot from EPC, application manufacturing, and maintenance and everything they do. So that's a big reason why CBI went out and got Shaw.
If you consider it cultural aspects, in terms of the culture of the acquirer versus the culture of the acquirer company, sometimes a mismatch in culture can derail the best financial plans you can move forward.
We did, and it was actually really interesting. The CEO spoke on that. He said the day after they announced the acquisition, that when the Shaw employees would go into work, there would be a CBI background on their computers. So they integrated really well, and they based that on the compatibility of the type of business that they have and the culture of the businesses and the engineers.
Follow up on that question, did you look into mismatch with regard to management team, management expertise, and corporate governance of the two companies?
Not specifically, but we know that they're bringing in the project managers, about 1,200, is that correct?
They're going to bring in about 1,200 additional project managers and supervisors from Shaw. And,
As well as the 3,000 nuclear engineers that they'll be bringing in.
But top level management, who's going to be?
But that's one of the synergies, the cost saving synergies they're going to achieve. They're only going to have one CEO, one board of directors, all the public information, all the public filing. There's only going to be one. So I believe that's about $30 to $40 million first day cost saving synergies that they're going to achieve from cutting that down.
Because you know, CEO's reputation can have great impact on the stock price and the tenure of CEO. So that depends on which team will be in charge of the business combination. That really can have significant impact on the stock price.
I want to go back to one of the points you made about margins declining. Can you expound on that just a little bit?
In the past, for example, we looked at like operating margin, and Shaw's operating margin was roughly 3 to 4% versus CBI's, which was normally around 8%. So we expect with the combination of the two that those margins will in the future decline. Not necessarily a lot, but we just expect since there are the lower margins from Shaw, that there will be lower margins with the combination of both companies.
So we expect the profit margin to start around 3.65% in 2013. Using CBI's expertise and efficiency, we expect that to go over 4%, the profit margin to go over 4% in 2013.
And Lummus was a great example of that. Before they purchased Lummus, they were having trouble with the margins. And after the acquisition, we've seen an increase in the margins of Lummus due to the efficiency of CBI.
Now we're talking about EBIT margins, obviously. We're talking about EBIT margins, operating margins.
Yes, operating margins.
To 3.5% to 4% is profit.
Now the revenue synergies you quoted is 150 million, correct? Now that's revenue, that's not operating, correct?
Can we go to the synergy part? We have two different synergies we're looking at. We're looking at about $55 million in cost saving synergies and $155 million in upside revenue synergies. And here you can see the revenue synergies in each segment, what benefits Shaw brings to CBI. And just to take a look at it, in the F&M, they're bringing about $31 million in upside revenue synergies. Power is 52, mega project 28, steel plate structures 3, and plant services 1.5, and so on. You can see these are the cost saving synergies. And first day, what I mentioned about the CEO showing the one board of directors, only one group of public filings, they expect to save about $30 million in cost saving synergies. In the next month 2 to month 12, they expect to save another $10 million and other general administrative and corporate.
All right.